What stays the same in 2026 and what will change? Do you have a game plan for that? What's your strategy? Or do you wait on the side with a lot of cash? Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk. Dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Gold investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. We are almost done with the 2026 series. Vero, what are we going to talk about today?
Well, today is the time to take action. So every
Yes.
year, investors, you should review your portfolio with a game plan in mind. Today, we will share the one Mike uses with you.
Yeah, just to make sure, there are thousands of ways to manage a portfolio, thousands of strategies. A lot of them works, and that's fine. So if you do not follow mine, that's not a problem. The point here is to have clear rules to make decisions fast and make them easy. The more you have dilemmas, the more you have hesitations, the less you are a happy investor. And we want you to be happy. So there you go.
Okay, so the first rules seems obvious, but it should never be overlooked. What's a good diversification, Mike?
So, a good diversification is all about being exposed to different opportunities and also minimize your risk of having concentration. So, it goes both ways. Of course, a lot of people will say, well, if you have very high conviction into like four stocks, you could make a killing. Fair enough. You just don't want to invest into Nortel, BlackBerry, Enron, and WorldCom because then it's going to be a tough ride. So I prefer to have exposure to different opportunities because, the running joke about me announcing a recession for the past 3-4 years still is ongoing. You cannot really predict what's going to happen next in the stock market.
Mm.
And you don't necessarily always know which of your stocks are going to outperform the market as well, or which kind of tailwinds is going to be the most important. So being diversified is not just about minimizing risk, but it's also about catching different opportunities. So every year, what I do is instead of moving my entire portfolio from one way or another, I just make small tweaks. If I think that, oh, I'm going to benefit a little bit more for AI or for energy, or I want to buy those consumer stocks that are having more problems right now. They're struggling a little bit more, so they're undervalued. So I'm going to invest in those. So this is the type of tweaks that you can make instead of saying, oh, I'm going to all in, increase my position into one stock or one sector by like 15%. That's a little bit too much to my taste.
Right. So a good way to improve your diversification or to solidify your portfolio is to identify weaker stocks. But how do you do that, Mike?
I qualify weaker stocks in two categories. The first one is super easy to spot. Those are your smallest positions. So a small position is just a source of noise and distraction in your portfolio. It doesn't bring much. I mean, if you have like 0.32% in a stock, it's not going to do anything. Even if it doubles in value, it goes down by 50%. So I like to attack those first. They are easy targets to decide, okay, I'm going to get rid of it, or I want to increase it a little bit more. So I have a diversification that matters. The second point of weaker stocks is the companies with weak metrics, not weak performance, especially not like, oh, I'm going to look at my 2025 and then report, and then I'm going to target those that are down in a market that is up double digit. I really want to look at the dividend triangle of each of those. Of course, I'm starting with the DSR Pro ratings and the dividend safety score. That's kind of like a shortcut for companies that have a weak rating. They will have weak financial metrics. So it's kind of like going hand in hand. But then I'm going to review them very carefully to see what happened, what's going on right now. Is there a plan? Is there a glimpse of hope? Or this company is just not what it used to and it's time to let it go. And by doing this cleanup while the market is pretty much trading at a all-time high is usually the best timing because you get rid of anything that could benefit from a false tailwind on a good narrative, but no metrics to back them up.
Okay, so then you need to write or review your investment thesis. What is it supposed to include, and when do you know your investment thesis is wrong?
So the investment thesis is super important in my process because whenever something goes wrong, I go back to the reason why I bought that stock in the first place. So the thesis is the story you tell yourself. It's how you like this company, why you want it in your portfolio. And the way we do it at DSR to make it easier to write an investment thesis, and that's what we do for more than 400 stocks, is we provide the playbook. So the playbook is literally how the company generates money. So it's super easy to understand because if you're not able to simplify it, it means you do not understand the business model. Then you're going to identify the growth vectors because it's one thing to be in business and be profitable, but then you need to know, okay, so what are the steps this company can make to grow the business? And finally, you
Mhm.
have the economic moats. So, what makes this business so special? What's the competitive advantage they have over their peers? Do they have like special technology, a close bond to their clients, recurring revenue, a sticky moat? So something that will protect their business over the long run. So that's how you write your story. But a good story needs to be backed with financial metrics. So the first thing is, even though I have a good story, if I don't have strong financial metrics, I know that something is wrong, and this would be a good reason to sell. I mean, I could tell you that I train with the best guy. I'm always at the gym. In my family, we have like Ironmans running, like marathons and stuff. My wife is a dietitian. Well, if I tell you all this and then you look at me and I'm 280 pounds, you're not going to believe that I'm an athlete. It's not making much sense. So facts matters. So when the narrative is great, but the metrics are weak, that is one reason to sell. The other one is sometimes you invest in a company with your investment thesis, but eventually the business takes another turn and they decide
Mm.
not to pursue some growth vectors that you thought were great. And now it's not part of the equation anymore. Well, then now your narrative is not even good anymore. So then it's also the time to let it go. Unless you are interested in the new narrative, but be careful to not fall into like this trap of like being in love with a stock.
So the next step is to trim overweight positions. But Mike, often like there are two questions that come with this step. Number one is what's an overweight position? And the second is why don't you let your winners run?
So again, the overweight position is different from one investor to another. So it's related to the exposure to risk to one stock. So it could be 3%, 5%, 10%, 25%. I mean, Warren Buffett at one point had 40% of its portfolio at Berkshire Hathaway in Apple. So definitely the overweight rule, he doesn't have that. He has a lot of conviction. Personally, I wish I had Warren Buffett bank account, but I'm not willing to take that kind of risk in my portfolio. And I don't want any of my stocks to be 40% of my portfolio because I would consider that as overweight. If there's a problem with
Mhm.
this stock, my entire strategy is at risk. My retirement plan is at risk. So then you have to identify where you draw the line. Again, the number is not important in terms of like you could decide to be at 6% maximum exposure. I decided to be at 10% maximum. So it will only help you to know when you have to trim. So as long as you're not above 6%, you don't have to take any decisions. So you save a lot of time. You don't have to watch the noise and stuff. You're just like, hey, I'm at 5% right now in this one. My risk exposure maximum is 6. I'm good. I don't have to do anything. And there you go. You continue your life and you're happy. You ask, why don't I let my winners run? Well, I do let them run. I let them run until it's too big. But when it's too big, I'm not going back to like 2%. Like, for example, I trimmed Apple 4 times already, but the 4 times I was above 10%, bringing it back to roughly 8 because I still believe in this business. The investment thesis is there, the metrics are there. So I don't want to get rid of a winner. I want to benefit from the fact that, hey, I actually made a right call here. So I want to ride this one as long as possible. But at the same time, I
Mm.
want to protect my portfolio. So it's just a matter of like trimming a little bit more. And from time to time, it goes from 8%, go back to 10. So, and then like, there you go. I sell another 2. So I still have plenty of shares of Apple and I enjoy most of the ride. But I, at the same time, if anything goes wrong, I know I am
And I mean, you cannot know that because you don't have hair anymore, but it's like when you go to the hairdresser and they cut your hair just a bit, they trim it to make it stronger. Like maybe you remember that like a time far, far away, Mike, but I used to do that.
I trim mine every like twice a week, so I don't get your point. They're already trimmed, but yeah, it's a lot of work actually to be bald.
Okay, jokes aside, another part of the game plan is to optimize your holdings, but what does it mean exactly?
It means to ask yourself this really tough question: where your money is best invested. Is it in this stock or elsewhere? How can you allocate your capital in a better position? And it's obviously sounds a lot easier than say than done, right?
Right. So how is that going about?
So, what I do with my portfolio is I look at those stocks in the specific sector, and then I ask myself, like, can I find a competitor or a company in the same industry with better ratings, better metrics? That comes also, we do have that at DSR with a replacement list, making your life easier. A good example would be, all right, so I invested in Scotiabank, and is it the best bank possible? Well, if you look at the financial metrics, not the stock returns. And actually, even the stock returns over the past 1, 3, 5, and 10 years, it's still worse than National Bank most of the time. Well, you look at National Bank's metrics, you look at Scotiabank's metrics, and then you understand easily why one is outperforming the other. So, this is a good way to determine which is the better stock. Of course, you don't know for sure. In the future, it could change. I'm always having fun to pick up on Scotiabank, and Scotiabank shareholders had a great run last year. So kudos to you. I'm just having fun here. But long story short, is more about the companies that are not performing that well or not showing strong metrics. Then you can dig a little bit deeper to see some of those replacements that could actually make your portfolio better in a sense that you're adding companies with stronger metrics, but you're still respecting your asset and sector allocation. So you're not moving that much, but you're still making some tweaks that are interesting.
And why is it important to have such a list?
Well, selling is so hard. I mean, you have a winner you don't want to let go because, of course, you're making money. You have a loser you hope that it will recover or recover to some extent. So you get rid of it at a better price. So you're always stuck not knowing when to sell. So, one thing that can help you having a replacement list like this is to get excited about your next move. So, it's going to be a great incentive for you to take action instead of like sitting on your
Mm.
ends and just wait and just making up reasons for you to wait even longer with your portfolio. So that's why I like, for example, I did not hesitate a second to trim my Apple shares this year because I mean last year because we're already in 26, mostly because I had Broadcom on that list and I really wanted to have it in my portfolio.
Right. Finally, if you are retired or about to retire in the next maybe 2, 3 years, a good way to protect your gains while creating income is to build a cash reserve, right, Mike?
Yeah, so the cash reserve is to fill the gap between what your portfolio generates in income and what you need to withdraw from that portfolio. So for some people, there's absolutely no gap. I mean, sometimes I have like listeners that are saying, but Mike, I generate like, let's say $70,000 from my portfolio each year and I only need 60. So do I need a cash reserve? And I'm like, well, you don't. You just don't want to be forced to sell at a bad timing. But if your portfolio is generating more than what you withdraw, actually, the real question to ask yourself is, do you want to spend more and treat yourself a little bit better? Maybe that's the key, right? Again, personal
Right.
choices here. But the key is really to just bridge that gap for 2, 3 years. 3 years is kind of like a great balance between having a cash reserve but not being too big. The thing is, the more you put money on the cash on the side, well, the more it hurts your expected returns. So it becomes less efficient. So yes, it could help you sleep well at night, and that's criteria number one. But if you need to generate 6% return in your across your investment to live the retirement lifestyle that you want, well, having 20% of your portfolio or 5 years of cash reserve probably is going to hurt your returns and you're not going to make that 6% expected return anymore.
Right. So, Mike, nowhere in your game plan can we find a place to invest in trend? Why is it so?
Because trendy is risky. Well, first, you never know when a trend starts and when it ends. And I mean, we were talking about those trends with kids before recording, and they start and spread very fast, but they could also stop in a second. And why would you want to become the bag holder in this kind of situation? So I rather focus on broad strategies and having a real plan instead of acting out of FOMO. So this is why I'm not a big trend guy. Sometimes you're going to be lucky or you're going to be right, but some other times it's going to go completely wrong, and we never hear about those stories of like, yeah, I went all into this sector and then it crashed. So nobody wants to tell you this. They're all going to tell you that they discovered the oil and gas industry in 2020, not before and not after 2022. It was just like I entered in 2020, I got out like end of 2021, make 500% return. I'm a genius. They all did that. Of course, no one was invested in the oil and gas industry before 2020. And these days, not that popular.
All right, listeners, to get more tips from Mike on how to invest in 2026, make sure to join us this Thursday, January 8th at 1 p.m. Eastern Time. This is like tomorrow. So join us for our live webinar. Live seats are limited but free. So make sure to save yours now at thedividendguyblog.com/webinar. The instant replay is also sent to all registrants. So if you can't make it, still save your spot and make sure to watch the instant replay. Thedividendguyblog.com/webinar. That's tomorrow. I want to see you in the chat. Okay. So if you need to catch up an episode from this series or to get related content, hit our show notes at thedividendguyblog.com/261. Tomorrow is the last episode of this series. We will discuss 4 stocks from the Dividend Rockstar list. Hit pause and the subscribe button underneath our podcast logo so you won't miss it. And until then, stay invested.
Stay invested. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.